How much tax will you pay in the great state of Arkansas on $60,000 a year in income? That's what we're going to dive in here today at the Heritage Wealth Planning YouTube channel. So join me as we run two scenarios, one on $60,000, of which $40,000 is from Social Security and $20,000 is from IRA distributions or TSP or 401k, 403b. You get it. And the other, we're going to have $20,000, the exact opposite. We're going to have $40,000 of IRA distributions and $20,000 of Social Security. Think there's not a difference? Well, think again. So we're going to dive right into this here today at the Heritage Wealth Planning YouTube channel. So if you like what you see, definitely subscribe down below and hit the bell to be notified for future content. Because I do about 3 hours of content a day, and you want to stay tuned because we are a financial planning machine here at Heritage Wealth Planning. So let's dive right into this. As always, we'll just start with my website, which is heritagewealthplanning.com, heritagewealthplanning.com, and you'll see the island from which I was raised on, Peaks Island, right here, and you know you're in the right place. So you go to the Tax Tools Interactive Tax page, all right? So heritagewealthplanning.com, go to the top right, Tax Tools Interactive Tax page. You'll see the first thing that pops up is the Tax Foundation's Interactive tax tool, which really incorporates the new Trump tax bill, and you can run a bunch of different scenarios here. It's fantastic, actually. So be my guest. Run all these scenarios until you're blue in the face. Doesn't cost you a dime. And then you scroll down to the Smart Asset state tax tools, which, again, they've allowed me to put on this website as well. And you can see all the different, there's just tons and tons of stuff on here, the Smart Asset tool. So you definitely want to use that as well. And we're going to go to the great state of Arkansas here. All right, so you click on your state. And we're going to go to Arkansas, and we'll see what populates for us. They put us in 71601 in the state of Arkansas. Now, remember, we're born in 1952 because we want to take advantage of the new tax, the standard deductions of folks who are 65 and older, which is $26,600. If you're under 65, your standard deduction is still a pretty good $24,000, but we're going to use the standard deduction of $26,600, and we're married filing jointly. And as we can see here is we got $40,000 of Social Security income. Oops, let me get rid of that right quick. And we're going to have $20,000 of IRA distributions. And what's our tax? $32 in Arkansas. Let me write this down because this is going to go to my forthcoming book, State by State Tax Guide for Retirees. And so here we got $32, okay, in state tax and nothing to the feds. So you got $60,000 of income and nothing to the feds. Oh, how could that be? That's well, that's the benefit of the tax law if you know what you're doing. So let's swap these around. We're going to now have $20,000 of Social Security and $40,000 of IRA distributions. Oh, what a change. What a change. I'm shocked. No, I'm not, because I know exactly what's going to happen here. So now we got $3,638 in taxes, of which $767 goes to the state of Arkansas and $2,800 goes to the feds, which puts us at divided by 60,000, puts us at a 6.03%, 6.06% effective tax rate. Still not too shabby, but I like the other tax rate better, which is essentially zero because we pay no income tax. Now I can hear what you're saying. How can that be? How can I go from nothing to almost 4,000 with just switching the numbers around? That doesn't make any sense. Well, watch. So I'm going to bring this up here a little bit. I got my trusty chart. All right, this is my whiteboard. And you can see the PI up here is called provisional income. All right, now provisional income, what that means is you take all of your other benefits, your IRAs, I don't know if you have capital gains, you got income, you take all of your other income, even tax exempt interest, my friends. You add all that together. In this case, we have $40,000 of IRA distributions. Then you take your it's actually 50,000. Then you take half of your Social Security benefit. All right, in this case, we got $20,000 of Social Security benefits. So our total provisional income is $50,000. All right, so we take $40,000 IRA, $20,000 of Social Security, and our provisional income in this case is $50,000. All right, so far so good. Now we take the first $32,000 of this. The provisional income is subject to no taxes whatsoever. The first $32,000 is not subject to any taxes whatsoever. Any amount between $32,000 and $44,000, 50% of that amount, in that case, the most case scenario would be $6,000, is subject to Social Security taxes. Any amount above $44,000, 85% will be subject to Social Security taxes. So what we do here now is we say we got in the second bucket, $32,000 to $44,000, we got $12,000. All right, so we know that we have $12,000. We times that by half, basically by 2. And so that's going to give us $6,000 is subject to Social Security taxes. All right. Now we take 50,000 minus the 44,000. That is the third band. All right. So we got 50,000 total provisional income minus the third band, which is 44,000. That's $6,000 times 0.85%. 6,000 times 0.85%. That's 5,100. And we add them together to get 11,100. That's the amount of money that is subject to of Social Security that is subject to taxation right there. 11,100. You guys with me so far? All right, so now what we do, we get 11,100 subject to Social Security. Now we got to add that to all of our other income, which in this case will be the $40,000 IRA distribution. All right, so 11,100 of our Social Security benefit plus the IRA, which is $40,000. And now we have AGI of 51,100. AGI of 51,100. Again, of our Social Security benefit, 20,000, 11,100 is subject to taxation. We have IRA distribution of $40,000. Let me get that out of the way. And so that means our AGI is $51,000, all right, because we just combined two. Now what we got to do, the AGI is just simply the amount of money you declare before you take your standard deductions. So what we got to do is we got to do 51,000 minus our two standard deductions, which is 26,600. All right, so 51,000 minus our two standard deductions, which is 21,600. AGI, probably should write that, standard deductions. 51,000, AGI, 26,600 standard deductions. Now I take my trusty calculator because I can't figure that out in my head. It's 21,500 total is our taxable income. 21,500 right here is our taxable income. And basically the first 19,000 will be subject to 10%, and any amount above 19,000 will be subject to 12%. So in this case, our effective tax rate for that right there is about 11%. But at the end of the day, we still have a significant amount of money. 26,000 is not being subject to any taxation whatsoever. So if you think about it, the first 26,600 of income is not subject to any tax whatsoever, because you got the standard deduction. All right. Now the next 19,000 some odd dollars is subject to 10%, and any amount above that up until 77,000 is subject to 12%. So in this case, that's where you're going to effective tax rate of about 6% income. The issue is you just got to remember the difference between provisional income when it comes with Social Security and provisional income when it comes with IRAs. The larger the IRA, the higher the provisional income is. The larger the Social Security, the lower the provisional income is. The lower the provisional income is, ultimately the lower your AGI will be, your adjusted gross income, which means the less taxable income you'll have. In fact, you won't have any taxable income when your Social Security, as we just showed you, when your Social Security is $40,000 and your IRA distribution is $20,000. Even though the reason for that is because you take your Social Security, a half of your Social Security, which is $20,000, you add that to your IRA distribution, which is $20,000. Your provisional income in this case is only $40,000, which means only $4,000 of your Social Security is subject to taxation, which is added on to the $20,000 IRA distribution. That's $24,000 of total gross income. However, your standard deduction is $26,600, which means you have no federal taxable income at all. So again, when people say, it doesn't make sense not to plan for Social Security because A, it's not going to be there, or B, I'm not going to get enough anyway. Bull crap, man. I just showed you right now. The difference between not planning for Social Security and planning for Social Security is $3,606 a year. And it's only going to get worse as you get older because your IRA distributions will grow as well. So if you live in the state of Arkansas, or any state for that matter, just remember, you heard it here first. If you're not planning for taxable income, because you're going to take Social Security early, I highly suggest you think again, because a tax man is glad you're not planning. So if you like what you see here, as always, go to the blog at heritagewealthplanning.com, mess around with the interactive tax tools, subscribe to the YouTube channel at just go down right now. Just go click on the bottom down there. You'll see the subscribe button. In fact, I even got a little reminder up there, a little pillow. Subscribe. What's that? A little bit of magic to make you think, brainwashing. Subscribe. And then hit the bell for notifications. Thumbs up always help me, my friends. So give me a thumbs up, and of course, comments too. We'll see you next time. Thanks now.